Imagine a world where your trading orders stay hidden from predators, gas fees vanish, and you trade derivatives right on Ethereum's mainnet without the usual hassles. That's what Synthetix is delivering this fall with their mainnet launch. If you're holding SNX or eyeing it, this could shift everything. Today, I'll break down the fresh announcements from Synthetix, explore why they're betting big on Ethereum now, and dive into my detailed chart analysis on the SNX USD pair to see if it's time to accumulate. Stick around because the technicals are pointing to potential upside, but with clear risks. Let's get into it. Recently, Synthetix dropped a thread on X highlighting their mainnet launch, and it's all about bringing derivatives back to Ethereum's roots. As you see in this post, while everyone's been chasing low fees on Layer 2s or alternative chains, a quiet revolution has been building on the mainnet. Synthetix is leading it, with infrastructure that's already deployed and working. They point out how Ethereum has improved dramatically since 2021. Gas costs have dropped 99%, making transactions affordable again. MEV protection, that's maximal extractable value, where bots can't front-run your trades, has become nearly perfect. Account abstraction is live, simplifying user experience, and liquidity has strengthened for institutions. Moving to the next part of the thread, Synthetix recalls the 2021 gas apocalypse, where simple swaps cost $100 and often failed. Multi-chain setups seemed like the fix back then, but they came with hidden downsides. Bridge risks led to over 2.8 billion stolen in hacks, which is more than 42% of all DeFi attacks. Delays in bridging killed arbitrage opportunities. Operations got too complex across chains, and liquidity splintered, causing big slippage on large orders. Now, Synthetix is flipping the script by building everything on Ethereum Mainnet for institutional-grade quality. No more managing trades across 6 chains. Their strategy includes a matching engine handling 100,000 orders per second with under 20 milliseconds latency, multi-collateral support for trading with assets like wstETH or sUSDe, gasless intuitive UX with zero fees, and direct deposits onto mainnet. Diving deeper, Synthetix Mainnet is rolling out multi-collateral margin soon. This means one portfolio opens infinite possibilities. Traders can deposit a mix of assets as margin, including yield-bearing ones, so your collateral stays productive while you trade. It's launching with 3 major types: sUSDe, Athena's yield-bearing synthetic USD stablecoin, wstETH, Lito's liquid-staked Ethereum, and cbBTC, Coinbase wrapped Bitcoin. With this, you don't have to sell your Ethereum, Bitcoin, or sUSD to trade. Instead, margin them directly, keep the upside and yield, open perp positions smarter, earn yield, and cut capital gains taxes. This is just the start. The architecture supports any ERC20 token with enough liquidity on Ethereum. Adding more opens doors to partnerships with core protocols, making Synthetix Perps a key tool in the Ethereum ecosystem. Capital efficiency like this pushes Ethereum forward. Here's an interesting take from Route2Fi, explaining how Synthetix Mainnet stands out. Unlike traditional platforms, it lets you earn on deposited collateral while keeping perp trades open. For example, using yield-bearing collateral like wstETH gets you Ethereum staking rewards of around 5% APY. This means you can trade and earn at the same time, turning idle margin into working capital. They describe delta-neutral basis trades. Deposit wstETH, short Ethereum perpetuals, creating a setup that earns both staking rewards and positive funding payments. This combines multiple income streams, boosts arbitrage profits, and stabilizes funding rates. Since you earn from collateral yields, you need less on high funding volatility. If you are comfortable with Aave or Fluid, use it as collateral, short the perp, borrow on the rate, and earn from funding, up to 25 to 35% APR. I recently made a video about Fluid where I walk you through every step. Check back later when you're done with this current one. I just put the link on your screen. So, as I was saying, pairing assets with offsetting perps forms natural hedges, lowering liquidation risk. Being long the asset and short the perp, or vice versa, cancels changes in collateral value and profit loss, making positions safer and more stable. If Synthetix Mainnet captures just 10% of total crypto derivatives volume, as this post suggests, it could generate up to $500 billion in monthly volume on Ethereum. That means more fees for validators and protocols, plus a flywheel pulling liquidity from Layer 2s back to Layer 1. Success breeds momentum, and they're calling it the missing foundation. Ethereum needs a perp DEX. Now, let's shift to the technicals on this 2-week SNX USD chart. Price is hovering around 65 cents, inside a long falling channel established since August 2020. The lower support connects lows from 2020, 2022, and 2025, while the upper resistance ties tops in 2021 and 2024. We're flirting with the 10 EMA blue line, not staying far, so a volume surge could cross it upward. But the real barrier is the purple 55 EMA, which rejected price in December 2023 and March-December 2024. First, we need breaks above the 10 and 21 EMAs. Fibonacci levels, anchored from the December 2024 top to June recent lows, show targets starting at $1.20, up to 14, but realistically, focus on nearer ones. The orange dashed line at 95 cents marks historical resistance. For newbies, EMAs are exponential moving averages, smoothing price data to spot trends. Crossing them signals momentum shifts. The green box is my load zone for DCA, dollar cost averaging, buying gradually, between 50 and 75 cents. Price is already accumulating there, so if you're out, this could be your entry. Never financial advice. The Fibonacci RSI indicator is oversold, pointing up with 6 green candles, hinting reversal. VRVP on the left shows point of control at 270, where most volume traded. My take profits. Green circles at 95 cents, 120, 170, 250, $3.70, and a small moon bag from $6 to $12, trimming percentages based on risk. I'm using trailing stops once profits hit. My invalidation. If the 2-week candle closes below the lower orange trend line, I'm stopping out the trade, but I'll hold my long-term bag, eyeing reaccumulation near 30 cents. Fundamentals look solid with Mainnet, but price action is bearish short-term. Patience is key. In my honest opinion, Synthetix Mainnet its repositioning derivatives on Ethereum, hiding orders, enabling multi-collateral, and potentially driving massive volume. Paired with SNX chart setup, it feels like a turning point, though markets can surprise. If this helped clarify your trades, hit the like button, drop a comment on your SNX targets, and subscribe for more daily crypto breakdowns. Check my previous Synthetix videos, links on screen. Thanks for watching. Let's build smarter portfolios together.